Hey, good morning, everybody, and welcome to today's episode of Derek Invest. I'm your host, Derek Miller. What are we going to talk about today? Well, something interesting happened in the market yesterday I want to discuss, and that is the divergence between the Dow and the Nasdaq. The Nasdaq has been the clear standout index in this price run up that we've been experiencing, the bull market that we've been in, and the Dow has been the clear laggard behind the S&P 500 and then followed up by the Russell 2000. What's happened is there's a divergence between the Dow and the Nasdaq, and even the Russell 2000 and the Nasdaq. We're going to look more at the Dow though, because the Dow has actually broken to new highs, whereas the Russell 2000 has not. So the Russell 2000, as we looked at yesterday, really doesn't have that many implications at the moment. The Dow, however, it could be one of two things here, and this is what we're going to look at. When there's a divergence between your leader, that can either mean that the leader has run out of gas, and now institutional money with their big footprints are going to move into the indexes that have not had as big of price moves. And so that can create a real trend shift. Conversely, there's something else that has happened in the Dow, and that's the E-minis. So futures in the Dow being traded are only $5. So it's $5 a point, okay, versus 50 in the S&P. What that's allowing is that's allowing smaller, intelligent, well, and non-intelligent, I suppose, traders and investors to get involved in the Dow. Could that lift price? Without a doubt. Without a doubt. So what we want to take a look at is, does this look like a trend reversal based on volume and a leader turning into a laggard? Or does this look like some sort of shift that we can't quite make sense of, which in that case, I would be inclined to believe it is the creation of the Dow E-mini futures market at $5 a point, which most people can participate in. Which can obviously lead prices higher, right? So we're going to take a look at that. And then what we're going to do is we're going to take a look at the NASDAQ and to try to get a little more confirmation as to what's going on. We're going to look at the five stocks that took the biggest price hits yesterday, right? That's Amazon, Meta, Nvidia, Google, and Apple. They are in the top 10 as far as market cap, and they took the biggest price drops yesterday. So the reason we want to take a look at that is we want to see what sort of volumes involved there, what sort of selling was involved there, and also for you short-term trading guys, and there are plenty of you that follow me. This will also give you some guidance on the upside. Where do we see it going? How quickly will it go there? So let's get started. Let's take a look at the divergence between the Dow and the Nasdaq and see if we can find some meaning there, and some price points where we think things are going to go, when we think we're going to go there. Is this the start of something bigger? So let's cruise over. I'm going to share my screen with you. I'll tell you what. Okay, well, I'm on the NASDAQ already. So let's take a look at the NASDAQ. We always started a monthly chart, everybody. Why do we start a monthly chart? A monthly chart is one of the better indicators for long term. We want to know in a long-term time frame, did anything go on yesterday that makes us think that it's something that could be like a world event, which would be back in 2008, 2009, 2010? Is it anything that could just be a regional kind of specific to the US event? And how we do that is we take a look at volume. As you can see here, there's absolutely nothing in volume to indicate anything. I would say that's about your average volume. I would also say that is effectively what's going on there. Probably where we're sitting now. Now we're only halfway through the month. Okay. Let's just delete that. Anyway, we're only halfway through the month, so the monthly really doesn't give us that much of an indication. Sorry, that took me a minute. I would say this is probably your average volume over the last, whatever it is, 20 years here. And we're barely over it right now, so I don't think there's much to be concerned about there. Let's take a look at the weekly chart. And I'm gonna, I always kind of move through these things relatively quickly for most of my broadcasts, simply because most of my live streams, simply because those of you that follow me know a lot of this stuff. But I'm going to talk through this a little bit more today because there are a lot of folks that are just now starting to tune in. So, look, this is the volume we're at yesterday on our weekly. This is, let's say, is this average weekly? I would say average weekly is probably about there. Probably your average weekly. So we've been well below traditional volume levels, but it's summertime, folks. There's nothing to be concerned about there. It does look like this week could be a bigger week in volume. Who knows? Thus far, no, not so much. Why do we care about volume so much, everybody? Because that is the footprints of institutional money. That's why. That is exactly why we care. Volume on a daily chart. Again, we're always looking at notional volume, everybody. We just want to know what is average volume roughly. If we're looking at a daily chart right now, I would say probably something like that is your average volume. If you look back here, I would say it's probably average. It has a few that are below it, some that are above it. It's probably average. Yesterday was well above average day. I would say in the last, what is that? That goes back to September of 23. Actually, this goes back to August of 23. So almost a year. There's probably, what would you say, 30, 40 bars there that are probably higher than average volume. One of them was yesterday. So that was a pretty big down day yesterday as far as volume goes. And as far as price goes, too, for a single day to be down 3%. Yeah, that matters. Let's zoom in a little bit. I don't see anything so far that looks, nothing's poking me in the eye that I go, oh my goodness, what would I say here? Well, if I'm looking at this chart, the first thing I look at when I start to zoom in is gaps. Why do I look at gaps? Because gaps tend to fill, specifically on indexes, okay? So if I'm looking at gaps, I see a little one here. All right. If I'm looking at gaps, I also see one here. Now, the big thing you have to ask yourself when it comes to gaps is, well, when should it fill? How long does it take to fill? Well, there's a rule there. I'm pretty attuned to gaps, and I absolutely love them, and I absolutely love to use them. And I can tell you that when you are looking at a gap, what you need to coincide with that gap is volume. Okay, so if you're on this gap here, this initial gap, and you see a large amount of volume in the trading day, that would traditionally mean this gap would fill very quickly. If you do not see that, that traditionally means the gap will take a little longer to fill. So is it unexpected that this gap has not filled yet? No, it is not, because the gap is taking place from here to here, again, here to here, here to here. There is no large volume stand out there. You would expect this gap to take some time. And another very, very good rule in gap theory is the further you get away from the gap, the longer it will take to fill. But also, the longer it takes to fill, the more precipitous the drop becomes. This is strictly for indexes, folks. But the further you start to get away from gaps, the more precipitous and extreme the drop in price becomes to fill that gap. Now, if we go to the most recent gap, which is the day before yesterday, when we look at the gap, here's price and then here's the gap. Is this a large amount of volume following that price drop? Well, it certainly is. So would we expect this gap to fill quickly? We certainly would, because there is this is probably 3 or 4 times the amount of volume as the day before the gap down and the price drop. So this gap should fill very quickly. It should fill very, very quickly. Okay, now let's move into a 1-hour chart. There's those gaps that we were just looking at. Okay, here we are. Look, is that large volume compared to the preceding volume on this gap down in price? Well, it certainly is. What's volume like now? Well, it's picking up. Should this gap fill quickly? Oh, most certainly it should. Very, very quickly. Whereas this gap, that's not the case. Look at the volume. It's not even noticeable. It doesn't even, it's meaningless. You knew that this was going to take time to fill, but rest assured it will fill. It's always the sooner the better when it comes to filling gaps, everybody, because the longer it takes, again, the meaner the price drop, the more precipitous the price drop. Here we are in a 30-minute chart. Here's our gap. It's at whatever, 490. Let's go to a 15-minute. All right, there's that gap. Right there. All right. Here you are. Do you have a lot of volume down here? Yes, you most certainly do. Remember, every chart's a new chart. In this price drop, is volume increasing? Yes, it most certainly is. The biggest volume is on the drop. All right. So we have to watch and see what that transforms into. But what that does mean is, as this thing is reaching new lower prices, it is having either more buyers step in, or institutions are deciding maybe it is time to sell. Maybe they are going to sell some of this stuff. Right? How will you know which one that is, though? How do you know which one it is? Do you know if they're starting to sell yet? No. But what you do know is that in the next 2 days, actually, it's summertime. Summertime, you always got to give yourself more room. Traditionally, folks, if your 5-minute chart looks like this, in the next 2 days, you should hit that price point. All right? Really, you should. And actually, that price point's a little high. I know because I just looked at it. You should drop this to there. All right. Now you come in on the 5. And it's a pretty simple thing to do here. There you go. That's your price. So we're going to change this all over to red. Actually, no, blue is correct. So we're going to go, what is it today? 7/18/2024. We have QQQ. We are price target of 490. Target date of what's today? The 18th, 19th, 20th, 21st, 22nd, 23rd. Probably the 23rd, 24th. Just go 24th. You can't miss there. It should happen much quicker than that, but it's summertime. We had volume on the price drop, which is actually quite interesting. But we most certainly have not had much volume over this summer. This summer has been rather light. So because of that, I'm going to give it a total of 4 trading days to get there. Ordinarily, if this were fall, that would get at maximum a 2-day window. That is all. It would get 2 days, and that's all it would need, and it would be there. Okay, so do we see any real selling in the Nasdaq? Did that divergence mean a change of the guard as far as the trend goes? Well, I can tell you this: I don't know yet. The volume doesn't facilitate that kind of that level of meaning. But is it possible? Yeah, I mean, from what we just saw, it certainly is. On the downside, it was picking up volume, not losing volume. Now, here's the divergence I was talking about. As you can see on the NASDAQ, let's go back real quickly. Let's go to a daily chart. That monthly doesn't mean a whole heck of a lot here. On this daily chart, you can see we reached the high on this on Wednesday, July 10th. Since then, we have fallen in the NASDAQ, okay? If you go over to the Dow, let's look at Wednesday, July 10th. Right there, all it has done is rise. It has gone from a high price of like 397 to 413. So you're looking at 16 points. You're looking at a 4% rise of the Dow. You're looking at what percentage drop in the NASDAQ? You're looking at a 503 to 484. So you're looking at 20 points. You're looking at a 4% rise in the Dow. You're looking at a 4% drop in the NASDAQ. Why does that have meaning? Because the Dow is a lagging index. The NASDAQ is a leading index. So there is an 8% divergence in those two indexes. That does matter. Does volume say anything yet? Well, volume on the Nasdaq has really picked up steam. We have the most volume we've had since what I say, May 31st. We have the most volume we've seen since the beginning of summer, and it came on a 3% drop in price. Does that matter? Oh, it most certainly matters. I'm not going to tell you that it's going to turn into anything yet, but this is definitely something we're watching. That gap should most definitely fill on the Nasdaq. It should definitely fill on the Nasdaq in the next 4 trading days, and that's to the upside, folks, before we can even start to determine if there's any real downside in play here. But it is an interesting situation because if you look at the Dow's volume, it is very contradictory to the Nasdaq. The Dow's volume is picking up to the upside. The Nasdaq's volume is picking up to the downside, which should create a larger divergence. This is something I have been doing this for 25 years. And traditionally, when you see this, this is the first signal of a trend change. We're not going to confirm that yet, but this is definitely one of the strongest and initial signals of a trend change. So let's break down the Dow. So here we are on the daily. As we can see, the daily volume 2 days ago is what? There's one other bar in the there's one day in the last year that the Dow has had a volume move like it had 2 days ago. One day, that's it. That's meaningful, very meaningful. On the same day that the Nasdaq had a 3% price drop, yeah, it matters. Okay, this is interesting. Look at the 4-hour chart. Look at the volume on the 4-hour chart. It is the largest, obviously, 4-hour bar in the last this year. It's the largest 4-hour bar this year. Let's go to a 1-hour chart. It's zooming, everybody. Things moving. Now, the nice thing is I don't see any gaps here below it to shove it through price, which means it earned this, which would lead you to think that potentially it is the creation of those Dow E-minis, the futures that you're able to trade at $5 a point that may have a good deal to do with this move. Is there anything here scary? No, you have big volume in the back, but that big volume in the back is driving price up. You're at a new high. Is volume dried up completely? No. Is it low? Yeah, but not dried up. Is this interesting? I suppose. This is moving price up. You know what? There's not really a lot to say on the Dow yet. The Dow doesn't mean that much. I mean, so what would we say about the divergence between the Dow and the Nasdaq? I think what we would say at this point, everyone, is we would simply say that the divergence of the Dow and the Nasdaq right now, the Nasdaq is definitely showing signs of a trend turn. It is showing the initial signs. Does that mean that there's going to be follow through? Not necessarily, but it's definitely showing the initial signs. The Nasdaq or the Dow, on the other hand, isn't really telling us anything. It's not really showing anything yet. If anything, you would say that, yeah, potentially with the creation of that E-mini, more people are just simply trading futures within the Dow, which is driving price up, right? That's what I would say there. It is definitely the Nasdaq is definitely something to watch. So now let's go ahead and take a look at Amazon, Meta, Nvidia, Google, and Apple, and see what we see there. Because they're part of the top 10 as far as market cap in the Nasdaq, and also they took the biggest price drops on our yesterday. They took the biggest price drops on July 17th, which was a 3% down day. So let's see if they look like that. Are they going to confirm the Nasdaq itself? Do they look like they have a rebound as well, or do they look like perhaps they are turning trend as well? Because a lot of times what will happen, your leaders will shift trend. Your leaders within an index before the index itself. So like, for example, if we go through these 5 companies and we notice that, hey, it hasn't just been the last 5 days that price has turned over. In fact, it's been the last 10 trading days. That is not a good indication for the index itself. However, if they have been flying high and just had a down day yesterday, that makes the index stronger. So we're going to look for strength or weakness within the index itself. And folks, any good forecaster trader has to look at things from a macro to a micro, and they have to look at all these little intricate details in the middle. Anyone telling you that they're picking price targets on moving averages or Fibonacci or whatever lagging indicator they're looking at, I promise you, as soon as the trend changes, they will be eaten up. They will give everything back every single time. We will not, because we are not just looking at lagging indicators and acting as though they are indicators of future price action, because future price action is dependent upon many indicators. And if you don't know how to read when price action is going to turn, when all of a sudden you're like, you'll watch a guy with Fibonacci, for example, he'll put a Fibonacci on a tight chart. He'll put it on a 5 minute, in a 1 minute. And every time it blows out, he'll just keep going longer in time frame. See, it'll turn here now. See, it'll turn here now. Well, let me tell you a secret about that person. A, he's going to run out of cash. He'll say he's just going to keep buying in and he comes back and blah, blah, blah. But that is most of the time completely untrue. He will run out of cash and then he will panic and he will sell. Because if you can't tell when a trend change is coming, if you don't know how to break down these indexes, look for divergence, look for the leaders, look for the laggards, look for the stocks within those indexes, right? If you don't, there's a lot more than even this, right? To identify a top or to identify a bottom, which is basically identifying a trend change, there's about 10 different things that you must look at. And it took me 25 years to become what I am at this now. So somebody thinking, some 26-year-old or 28-year-old, he might think he's good, or maybe he is, right? I thought I was really good at 28. I mean, I was managing, not a ton of money. I was just a broker, but I was managing about $100 million. I had 35 clients. I was good. I was nothing compared to what I am now. And that's why when I take on a new student, I take it very, very seriously. And that's why that person is usually with me for about a year, so that they can follow me through. And most of my students subscribe to my newsletter, which is really, it's a video letter, and they just never stop, because I give you insight each week into what I see. And that just helps you stay on track. And most of these guys have enough money and they make enough money through the trading activity that they've learned from me that the cost is inconsequential. So in any case, let's take a look. Amazon, Meta, NVIDIA, Google, and Apple. I'm going to share my screen with you now. All right. Why don't we take a look at Amazon first? And as always, guys, we're going to zoom out. We're going to get into the monthly. We're going to get into this monthly. We want to see what they have looked like. Now, if you look at Amazon, Amazon is just now at the 2021 highs, okay? On this month is a horribly negative month for Amazon. It's gone from 200 to 187. Is that different than its underlying index of the Nasdaq? Absolutely. Amazon is down here at the 21 highs, which is, my goodness, 25% lower than where its index is. Okay, so Amazon's lagging its index. All right. Now, let's look at it on a weekly chart. This is what you're doing when you're looking for strength and weakness. On a weekly chart, it was at the current levels. What is that? June 24th, okay, is when it was up there at 200. So now it's down at 187. So in the last month, it has lost 6.5%, 7%. That is not strength. What has the index done in the last month? Let's look. Well, in the last month, what did I say, June 24th? June 24th, the index is still up. No, it's about even. Just call it even. All right. It's even. So Amazon is down, 6.5%, 7%. The Nasdaq is even. Let's go back to Amazon. I'm going to do this for Amazon. I'm going to kind of flip back and forth like this for this first one. After this, we're going to kind of know the numbers of the Nasdaq, so I'm not going to do that. Now, when did it reach its high price? Well, Amazon reached its high price on June 27th. When did the Nasdaq reach its high price? Also, the price that Amazon sits at now was attained back on April 8th. Amazon has gone nowhere since the beginning of April. Let's take a look at the Nasdaq. Where was it at the beginning of April? April 8th, right here. Okay, 445. It's now at 483. Call it 40 points. Call that 8% higher. I think it's safe to say, everybody, that Amazon is weak compared to its underlying index. All right. Amazon is most definitely weak compared to its underlying index. I'm not going to give you price targets on Amazon right now. What I want to know is it strong or weak compared to its underlying index? Let's just break it down. Let's take a look and see what we see. There's no large gap like there was on the Nasdaq. So when it comes to Amazon, you're not looking for a big bounce up. If you own Amazon, you are not looking for a big bounce up the way that you are in the Nasdaq. All right. Here we go. 15. Do you see large volume at the lows? Is there huge volume as the price dropped? No. That means there's not that much interest in this position to begin with. Okay, I think that's the end of Amazon. We're good on Amazon. Amazon is weak compared to the underlying index, and there doesn't appear to be a ton of interest in this company. The index is probably just carrying it, along with its other mega cap stocks that are involved in the index. Let's take a look at Apple. What does Apple say to us? Apple looks a lot like the index, probably even a little stronger, simply because back here are your 21 highs. It broke to new highs and sort of stabilized before it broke back through. So Apple, does Apple look strong, weak, or neutral? I would call it neutral. Remember, it's just notional, everybody. Just take a look. Is on a weekly chart, is it strong, weak, or neutral compared to the index? Now, this chart may look a little different. Look, from a notional standpoint, I would say that Apple is neutral still on a weekly chart. Let's look at a daily. On a daily chart, I would say 235, 227. There's strength. When the market pulled down pretty darn hard yesterday, Apple didn't. Why might that be? Probably this volume right here, because this is definitely somebody buying the dip. This is institutions buying the dip, everybody. This is a here, look right here. When I talk about the footprints of institutional money, I'm talking about things like that. All right. That stands out head over feet above all other volume on that chart. And that's probably why the pull down was minimalized yesterday. So does Apple show strength or weakness? I would say Apple shows strength. 1 hour, strength or weakness? Strength. The pull down was very, very light compared to the underlying index itself, right? And as far as the price drop, sure, that's why we're looking at it. It was one of the largest price drops in the mega caps that are in the Nasdaq right now, pulling the index along. But we're looking at overall strength and weakness. I would say it's strong, stronger than its index. All right, we can move on from that because it is, in fact, stronger than its index. Let's take a look at Google. What's Google look like? On a monthly chart, well, this month looks horrific. But from a strength or weakness on a monthly, the month isn't over, so we can't judge the month. I would say that it looks just like the underlying index. Let's take a look here. Strong or weak compared to the underlying index? I would say neutral again. Let's look at the daily. Neutral again, does not have that large gap that the underlying index had. This right here is very interesting because this is definitely the footprint of institutions. It's basically sitting at the price we're at now. It'll be interesting to watch Google play out. Is there anything here to be afraid of? No. Let's move on. There's nothing to be afraid of with Google. Let's look at NVIDIA. Well, how's the video look? NVIDIA looks the way it has looked, right? Now, does NVIDIA look weak? Well, the high price last month was 140, right? Almost 141, and you're sitting at 116. Yeah, that's weakness compared to the underlying index for sure. Now, hold on. Go back. I didn't mean to just skip to the 1 hour. We got to go to the weekly. All right. How's it look on a weekly basis? Not good. Not good. It doesn't have the big volume, which in NVIDIA's case probably means a lack of interest at those price levels. Okay. Now I called for NVIDIA to hit, I think, 121, and it did. And that was not last week. It was the week before. And I did like a three or maybe it was 1 week forecast. It hit its 121. Now it's down here at 119. And NVIDIA is definitely showing more weakness, everybody. Without a doubt, NVIDIA is showing weakness there. A lot of weakness. not only compared to its underlying index, but compared to the other 10 mega caps that it runs with. And you have a gap down here at 98. So looks like you have a little gap here too, which would get you to this low of what, 124. Let's zoom in a little more. I'm just going to go to an hour. No, it's not really even a gap. Price is hit there. Nvidia has weakness. Period. Nvidia is weak. It looks like there's a 198 sitting down there that it could very, very easily run to. And it could run, or not 198, 98. There is a $98 price target that Nvidia could very, very easily run to. What have we done so far? We did Amazon. So we need to do Meta, Amazon. Oh, just Meta. All right, so let's take a look at Meta, everybody. Meta is not strong compared to its index at all. That is pure weakness. On a monthly chart, you are sitting back at price levels of February of this year. It has almost given back the entire year. Why is Meta still sitting up here? Right here. This is institutional footprints, folks. Right here, right there, and right there. That's institutions. That's buying. Piece of cake. Call that all day. This is a lack of interest. You see, they're interested down here. They're interested down here. Now, price has risen 500%. There's no interest. I would look for big drops in Meta. Meta is ugly, and I would look for big drops. I actually have price targets on Meta. If you follow me, if you're one of my students, we've been talking about Meta. But trust me when I tell you, I am discussing Meta independently of what I have seen in the past. I am just talking about what happened yesterday and whether it has strength or weakness in its underlying index. And when you look at this on a daily chart, where your daily charts up here at $500 have the most volume that you've seen, and it gaps up and pulls back down, this is retail and this is institutional investors. This is institutional investors selling to retail investors, everybody. That's all that is. You run from 105 up to 500, and up there at those $500 prices, you think any institution is buying it at these levels? You're nuts. This is called churning, and this is for retail investors. Retail still thinks they should be buying dips. They will, and they're being sold to. Meta is ugly. If you own it, it's a bad idea. Now, it's up to you to understand your time frames, your price targets, what you're looking for, right? As you know, when I run portfolios, 50% is in long term. Sometimes it's 25% is in long term. It depends on the individual's use of futures and options and their understanding of those, because you can mitigate taxation through futures and options rather than buying and selling your actual positions. But it depends. Everybody's not cut out for that, and that takes time to build into. Nobody should be jumping into those markets. I would never advise anybody to start off in futures or options. It moves too fast. You will lose. Again, you can use your Fibonacci's and your moving averages and your support and resistance. You can use that, and it'll work until a trend change. And then I promise you, you're not only going to give it all back, you're going to give more than that back, because it's going to take, you're not going to understand what's going on. You're not going to understand why it's not working, and you're going to run out of bullets. And don't do that. Just don't. There's easy ways around this. There's guys like me that have been doing this for 25 years. I never, ever touched an option or futures for 15 years. There's a reason for that. I know better. The stock market and the futures market move in exactly the same ways, but the futures market is moving at hyper speed. It'll eat you up and spit you out. Now, the benefit of learning through the stock market is I had to develop patience that a futures trader doesn't have. I would have to sit through losing positions and wait for months on end. Months on end. On a futures chart, what'll take you 30 minutes to get to, I used to have to wait months. You want to talk about patience? You want to talk the ability to withstand and stay disciplined? Go work in the stock market, but work in the stock market where you actually buy and sell, not where you just sit there and go, I'm in it for the long term. And there are ways to be in it for the long term, but you better know how to use futures and options if you're not buying and selling positions. Otherwise, you're not in it for the long term. You're a buy and hope strategist, and that isn't a strategy. Buy and hope is not a strategy. Oh, well, the market always goes up until it doesn't. And by the way, everybody that thinks they can withstand 35% and 50% drops, they can't. I managed money for 17 years. And let me tell you, clients, every time they would call up, or when I would be getting a new client, all I heard was how they were buy and hold and they held through it. And I will tell you that 99.9% of the time, and I can only think of one client in the history of all the people I worked with in 17 years, I can only think of one person that was honest with me about the fact that he held through a market drop that was plus 20%. There was one, and he did it. One in 17 years. So if that's you out there, I know the lie feels good when you tell it to your friends, but if you're tired of that and you actually want to start learning to do this stuff right, reach out to me. All right. This is my Twitter handle. If you think that like what I show you is it's just luck, or you can't do that over and over, or other people, they would be doing it, right? Oop. Let's go back to that. I messed that up. Sorry. If you think that's not the case, listen, I take pictures of the charts that I put up. I show you evidence of what I do. And let me tell you something. At first, I wasn't giving you exact target dates and time frames because I didn't want to just give away my secret sauce. But for the last 2 months, I have been. You want to check my accuracy of the last 2 months? Please do. Before that, people are going to go, well, you said it was going to go here. Yeah, but a lot of that stuff I was talking about long term. I was talking about over the next 12 to 18 months. Now I've started to set target dates. You want to look at my accuracy? Please do. Okay. What I do works across all markets and across all asset classes, because what I do is I look for the footprints of institutional money, and where those footprints are taking place tells me what institutional money is doing. And then I do it too. And so do all my students. And I have students that can tell you, and I have tons of reviews that can tell you how successful it is. If you're ready to actually take the next step, if you're ready to do what I'm showing you, if you're ready to learn how the market actually moves, even if you're crushing it in this up market, I'm crushing it. I don't need help. Believe me, when the trend changes, you will. Everyone's a hero in up markets. Look, 2008, 2009 made me as a stockbroker and a financial advisor. I never had to prospect again, never. Okay. 2020 made me as an educator and a one-on-one advisor. An advisor, meaning I teach you how to do this, and then you get weekly video updates on exactly what I see. And when I work one-on-one with you, I go through your positions with you, and I tell you exactly what I see. So you get the benefit of 25 years of experience specific to you, specific to your RIA, specific to what you're doing. All right, everybody, thank you so much for joining me. And remember, if you're not good up here, you're not good anywhere. Mental health is the most important thing in your life. Whatever problems you have going on today, you're going to solve them. You've never lost yet. How do I know that? Because here you are, tuned in, talking to me. You've never failed. You're not going to fail this time. You'll figure it out. Remember, sometimes you do have to fake it till you make it. Throw on that smile. Get outside in the sunlight until it becomes real. If you need someone to talk to, reach out to me. There's my email address. If you simply go on to prometheaninvesting.com, you can find my cell phone number. I don't hide where I am and who I am. I have no interest in that. I want people to know who I am and what I'm about, because I want you to trust the fact that what I do is real and what I talk about is real. I'm not some charlatan looking just to get your money. My success depends on your success. Not like a financial advisor that charges you a percent on your money and then says when you lose, half of your money, so you have $1 million, you lose $500,000. He lost $10,000 a year in fee, right? That's all he lost. If you lose half the money, actually he lost $5,000 a year in fees. You lost $500,000. That is not what I mean. What I mean is we are on the same side. Your success does depend on me. And that's why I choose to do one-on-ones. I have a mentorship program that I talk about sometimes. And I do them occasionally. I'm not going to do one this month. I'm probably not going to do one next month either. The one-on-one is far more interesting for me, and it gets my students a lot further. The mentorship program works if I have a group that is already established. But without that group established, having people come in one at a time, it doesn't make a whole heck of a lot of sense. They don't trust each other. They don't know each other. They don't know if the other person is a real person in there. They think that I put them there, which I would never do. In any case, look, if you need me, reach out to me. Other than that, every day above ground is a good day, and I will see you all tomorrow.